Pros and cons of SBA loans.
Deciding whether an SBA loan is right for you means weighing the pros and cons of SBA loans versus other types of loans. I'll explain some of these pros and cons to help you make a better decision.
Here's a summary of the pros of SBA loans. Built to support small businesses, the loans can be used for many purposes: easier access to credit, potentially lower interest rates, favorable loan terms and fees, low down payments. Let's look a little closer at each of these. Sometimes business loans can seem built for large businesses. This can be true because larger loans are more profitable for many lenders. These lenders then tend to work more with larger borrowers. However, SBA loans and SBA lenders specialize in working with small businesses. They understand the needs of small businesses. Some SBA loan programs have simplified application processes. Some programs also provide support and guidance beyond the loan itself. The standard 7A loans can be used for a wide range of purposes. 7A loan funds can be used for everything from short term working capital needs to long term funding for real estate purchases. You can use the funds to establish a new business or expand operations. The Community Advantage program can fund changes of ownership. Disaster assistance loans meet unique dire needs in time of need. Microloans fill a need that's often not met by traditional lenders. These types of loans can sometimes be hard to get a loan for without the reduced risk to the lender provided by the SBA loan. Prime lenders like banks and credit unions are required to have a low tolerance for risk when making loans. Small loans and small businesses are less profitable than large companies and large loans. When banks have limited capital and funds to lend, they have incentives to focus on larger companies that are more profitable and may be less risky. SBA loans provide incentives for these lenders to serve small businesses. The SBA guarantee of a 7A loan or the junior lien of the 504 loan reduces the risk to the lender. Lenders can sell the guaranteed portions of SBA loans at a gain, which also frees up funding and capital. Many times during periods of economic stress for small businesses, the SBA has added programs or made programs more favorable to small businesses. Lenders charge high fees for high risk borrowers. SBA loans reduce the risk to the lender, which can reduce the interest rate required by the lender to make the loan. Some SBA loans also come with mandated rate caps. Some loan programs have very low interest rates. SBA loan interest rates and fees may be much lower than those charged by non bank lenders. The maximum repricing term for many banks and credit unions is around 7 years. They often require a balloon payment of all outstanding principal amount at 10 years. You can get fixed rate loans with no balloon payment with a 25-year term with SBA loans. Some lenders offer long term fixed rate loans but charge a yield maintenance or make whole prepayment penalty that can be very expensive. SBA prepayment penalties can be much lower than normal prepayment rates. Down payments can be as low as 10% for both the 7A and 504 programs. This is lower than the 20 to 25% down payment that's common for standard commercial real estate loans. And now, a summary of the cons of SBA loans: eligibility and restriction on use of the funds, potentially higher fees, longer loan approval process, more paperwork, and collateral and guarantee requirements. Let's look at each of these in more detail. While SBA loan funds can be used for many things, they can't be used for everything. Some programs are limited to certain uses. Some programs have eligibility requirements that your business may not qualify for. 7A borrowers pay a guarantee fee that wouldn't be required for regular loans. 504 loans come with a series of one time and ongoing fees that may not be charged if the borrower weren't borrowing through the program. While these fees may seem high, the all in cost of an SBA loan may still be lower than a loan without SBA assistance. The borrower may not be able to get a loan at any cost without SBA assistance. Getting SBA approval adds another layer of review and approval to the loan application process. This can be reduced by working with a lender who is part of the Preferred Lender Program, PLP. These lenders aren't required to submit loans for full SBA review. Using an express program also reduces turnaround time. Government programs mean government forms. Lenders have their own set of loan application documents, and the SBA loans require additional documents. Some lenders do a better job than others in reducing the duplication of paperwork. SBA loans promote public policy goals, so some paperwork is required to monitor the effectiveness of the program in meeting these goals. Owners are required to provide a personal guarantee for SBA loans. Small businesses may have to pledge more collateral or different types of collateral than what would be required with a normal loan. Once again, this may be the price to be able to get a loan or to get a loan with the benefits of an SBA guarantee.